I think Izzy, we can start.
Yeah, perfect. So, good afternoon, everyone. Thank you for joining us today. As an introduction, my name is Isobel Morgan. I work in the tax department at Bevan Buckland, and we're joined by Matthew Denney, a partner here. So, as you're all aware, today's webinar is focused on company restructuring, specifically the tax implications and planning opportunities that arise when businesses need to change their corporate structure. Whether you're advising clients or thinking about your own business, we want to give you a practical overview of the key considerations and scenarios and how to navigate them in a tax efficient manner. We're going to cover 5 distinct restructuring scenarios in today's session, and we'll walk through each of them with some real world context, the relevant tax reliefs, and visual diagrams showing the before and after structures. We couldn't possibly cover everything off in one session, but these are a few of the ones we see most often in practice. We will leave some time for questions at the end. We should be here for about 40 minutes, so please do leave your questions as we go along in the Q&A section. I believe there's 3 dots somewhere on the screen. The chat is disabled, but you can leave your questions in the Q&A area. We can see them. This is being recorded, but none of your faces or mics are on, so you won't be part of it. So to get started, I think Matt's going to discuss firstly why you would be looking to restructure.
Thanks, Izzy. I've already got one hand up. I don't know, Kerry, if you're able to click on the the panel so that you can't the Q&A's not working, but there's 3 dots at the bottom. And if you click on that, sorry, the chat is not working. There's a Q&A, and I'm able to see any questions in there. But yeah, so if we go on to the first slide, please, Izzy. Right, so we're going to go through. If you look to the right hand side, we're going to go through a few of the variants that are we see most typically, so most likely to be applicable to clients of our firm. What's called a company purchase of own share, sort of like a holdco restructure, maybe just putting a holding company on top of your existing trading company. A sort of a more standard kind of management buyout type of arrangement. Something a bit fruitier, a capital reduction demerger, a more complicated and expensive transaction, but something that people would benefit to be aware of. And if we get time, we'll move on to sort of removing unnecessary subsidiaries. Some like warning signs on the left, we can help with getting these things right. Getting it wrong is costly. Quite often, I would say that people don't know they've got these things wrong until they come to sell their business, and then on the due diligence, they discover what they've got wrong and how bad that can be. But with the right advice, all these things are eminently doable. If we move on, please, Izzy.
Of course. So, as Matt's mentioned, the first thing we're going to discuss is a purchase of own shares, otherwise known as a share buyback. This is one of the more commonly used restructuring tools, and it's particularly relevant where a shareholder needs to exit a company. So why does this arise? And there's various reasons why we might be looking at doing a company purchase of own shares. It might be that there's been disputes or disagreements between shareholders and nobody can agree on a way forward for the business. We might be looking at somebody retiring. They want to exit, but everyone else wants to carry on. They're not ready to go yet. We might be looking at divorce. Sadly, we're in scenarios where the court needs, people's shareholdings to be realised as part of orders. And also sadly, the death of a shareholder where people need to realise the shareholdings for the estate. We might be looking at removing somebody who's just sort of in the share capital and doesn't have any involvement, or somebody who may have inherited those shares from somebody recently. Or we might just be tidying up the share capital in readiness for a sale, because having loads of minority shareholding can just cause complications. In all of these cases, the company would be buying the shares back themselves rather than any of the continuing shareholders purchasing them personally. So I think Matt's now going to talk through how it works.
Yes, please. So a few things first before I come on to this slide. So when we think of a company purchase of own shares, in one sense, it's the simplest because there's no additional companies. It's usually the cheapest from a stamp duty perspective because we're only paying stamp duty at 0.5% on the shares we've bought back. And so in one sense, it's the simplest and cheapest because you don't have the extra stamp duty cost, extra companies. But in terms of the conditions, it's also kind of the hardest to come into. Okay. And the most sort of critical thing about a company purchase of own shares is that the person you're buying the shares off or the company's buying the shares off will want to get capital gains tax treatment and pay less tax. And that's where this company purchase of own shares gets more complicated. It's also worth pointing out the company buys the shares back, not the other shareholders. So when you think about how that might vary in cost, if a company's got to find £1 to pay to buy back a share after corporation tax or before corporation tax, that's about £1.33. If one of the individuals was to buy the shares off the other shareholder and they've got to pull money out as income, well, that could cost as much as £1.81 roughly after paying your 45% income tax. So it's a very useful way of doing things, but it is more difficult to come within the tax conditions for capital gains tax treatment. The good news is that you can get in fact, you are required to get the treatment to put in a clearance application to HMRC, and that gives the seller of the shares the comfort that they will be paying the lower rate of CGT, and if they've got their business asset disposal relief allowance available, they'll be paying 18%, not 24%, which is obviously a lot better than paying income tax of rates up to 45%. The essentially what the revenue are looking at is that this is a person like as he went through those examples that's what it's for. It's not being done for tax purposes. You're not going to have some of your shares bought back because you quite fancy taking some money out at capital gains tax rates. They want to see there's a benefit to the trade, and they also want to see a sufficient reduction in that shareholder's shareholding. And actually, I've messed it up. It says 5, it's got to be 25, isn't it? I've deleted the
Yeah.
two mistakes. So where it says 5%, that's a 25% reduction. But it's tested. It's quite a complicated calculation because it looks at once you've bought the shares back, there are less shares. So you've got to run that test on the undiluted share capital. I think another two really important things I'd say about this are you can only do it if you have reserves. Can't be done without reserves. That sometimes means it can't be done this way and we have to do it a different way. Um, and what was the second most important thing? The distributable reserves. Oh, the five-year ownership to get the CGT treatment. And there was one more thing, and it's just completely escaped me. So I'll come back to it. It'll come back to me. As we go through the others, we'll see how this one compares. It's like a go-to if you can come within it.
Mhm.
What's the next one, please, Izzy?
So just before we move on, like just to give you a visual on how it looks, you can see here just, 3 shareholders in a company. One of them looks quite unhappy. They want to get going. And so after the buyback, you can see the happy shareholders are carrying on with the company. And now that shareholder is happy and on their way because they've been able to realise that investment. But again, because they met all of the procedures. So the next thing we might look at is something we refer to as a holdco restructure. It's got lots of iterations, and this tends to arise in situations similar to a purchase of own shares, but when the company maybe doesn't have those distributable reserves to buy the shares back, and we need to look at alternative routes to relieve that shareholder of that duty per se. So again, why would you do it? Similar reasons to that with the purchase of own shares, unhappy shareholders, people looking to retire following death, inheritance. But the most common trigger for this route is therefore when you don't have the distributable reserves to do that purchase of own shares in a buyback. It might be that, you have someone wanting to leave and you have a really happy unit in your shareholding and you don't really want to be bringing a third party in. It's going to rock the boat and cause some issues between yourselves. The company is working well. Just that shareholder's point in their life or career is not aligned with your own. And and also it might just disrupt other things, ruining client relationships and stuff if somebody came in and changed the way everything was done. And therefore you don't want to bring in that third party, and you want to try and give that person the share, the capital that they've acquired and buy their shares back, but the company's not in a position to do so. And so we look at doing the holdco restructure instead. Matt?
Yeah, so the what I'd forgotten was on the share buyback has all the plus points. The one thing that is absolutely critical is that it's done correctly within accordance to the Companies Act, because if you don't have it done correctly, it's null and void, which essentially means the person you thought had sold their shares back to the company hasn't. And that only ever gets picked up on a due diligence when you come to sort of exit the business and sell the company. And the lawyers go, oh, actually, you haven't done this properly. And then you've got to go and rectify it. So whilst it's really attractive when it can be done, because it has the least amount of cost and stamp duty, it's the most critically important one. But it's important we get them all right. But the repercussions of getting that one wrong are more disastrous and more difficult to fix than elsewhere. So this one, as he's pointed out, if you haven't got reserves, you can't do a company purchase of own shares. With a holdco structure, we essentially can. Even if so again, it's not individuals using their own money, it's company money or existing company money or future profits um, funding the consideration. Any ongoing shareholders can roll over their shares into the new company and they don't have any tax to pay. And the exiting shareholders, their tax will depend on how they take their consideration. But all the consideration is typically funded by TradeCo, essentially lending money up to the holding company, even in the context of the trading company borrowing money from a third party. Those loans will typically come into the trading company. They'll be lent up to the holding company, and then that will fund the buyout. There will be more stamp duty. So if you're got a £1 million business and a 25% shareholders exiting, you'll pay 0.5% on the full 1 million, not just on the 250,000 pounds coming out. The plus side is that the tests are less strict. Again, we can get a clearance from the revenue. So if, say, for example, someone doesn't want to reduce their shareholding by 25%, like a family member, um, they may not have to in this model. They may, as a rule of thumb, people would generally need to come to around about 30% of ongoing ordinary share capital, but they would be able to keep usually more shares than in a company purchase of own shares and still get a capital gains tax clearance from HMRC. Does the next slide carry on with this one, is he? Go
Yeah,
through.
it just shows the sort of diagram, same sort of structure, but with the use of the holdco instead.
So that's essentially where our additional costs come in, because now we've got another company. Um, that said, sometimes there are benefits to having that additional company. So if you've got a situation where um, you have a high risk trade and you have lots of assets, you might be quite happy to have a holding company into which you can distribute your assets to ring fence them from the risk that the trading company gives you. Um, where it can be a little bit more painful is your trading company, if it's lending funds up to the holding company to fund the purchase of the exiting shareholder, you can end up with quite an ugly stroke untidy balance sheet in your trading company, because it'll either have to dividend profits up to the holding company, which will obviously reduce its reserves, or its reserves will be represented by a debtor balance due from the holding company. Now, of course, there's no possibility of that holding company repaying that loan because that money's gone out the door to the exiting shareholder. So there are some things to work through and think through, not just from a tax perspective. We've got to think about some of the commercials around it and also some of the accounting ramifications down the line. Okay, so we've done Holdco, company purchase their own shares, they get more complicated now, don't they? Is yours the next one a bit more straightforward?
Next one's okay, and probably what everyone's seen referred to in many pieces of documentation, the management buyout or the MBO, probably seen everywhere. It's very regularly referred to. And this is where you may have an existing management team within your company. They know exactly how it works and how to keep it going well. And we bring them into the ownership structure. And this is, similar reasons, really. Somebody might be looking to step back from their role or retire, and they don't have any natural succession. There may not be any family members willing to take it over or even there. Or it might be that actually you have a company, you've had a really loyal team for lots of years that absolutely love their job, have always done everything for you, and you now want to reward their loyalty and performance by giving them the opportunity to buy in. I think it's pretty fair to say that there's nothing that locks someone into a business like owning a piece of it. It obviously would keep the business, with continuity. The management team knows your business better than most people, sometimes better than yourselves. I'm sure you would admit. And allowing them to take full control can be really beneficial. Or it might be that you are looking to step back and there just is no external buyer. You may have a really niche client, client base, really niche business, and you're not going to get a realistic value on the open market because of certain scenarios, but you've got a management team that are ready to take on the challenge. And therefore, we look at doing a management buyout in which they come out of employees and become a member of the shareholders. This can look, loads of different ways. There's loads of ways of bringing people in, but it's really important that it's managed carefully for tax purposes. And Matt will go through that now, particularly with the value of the shareholding that these management team take on. But it might be something that you are considering and think, well, I've got this amazing team. How can I keep them? Or how can I reward them for everything they've done for me, but also take a step back myself? So, yeah.
Thank you. And in that sort of those circumstances, so we have you talk about lots of different varieties, and that then also plays into the funding. So, people exiting their business will have a view on the value of that business, but that doesn't necessarily correlate with what that company can borrow. And so, whilst it might have some cash resources to make an initial payment, and whilst it might be able to borrow from a third party another amount of money, that might not still come to the valuation expectations of the founder sellers, and therefore this structure allows for that consideration to be made up in a number of ways, including keeping some of the ordinary shares. You can roll over some of your ordinary shares. And you may also have you could have an earnout, less likely in an MBO circumstances. More likely would be some deferred consideration, either some loans that are owed to you or possibly some preference shares. Going through these points, there's some useful points in here. So I'm going to start in a different order to the slide. So EMI share options. This is something people need to think about really before the management buyout, because if you're going to have third-party financing, the third-party financier will generally want the management buyout team to have some kind of financial risk, some sort of skin in the game. Now, that could be they had to find some money and put some money in for their ordinary shares. That sometimes is not realistic. Even £50,000 might not be raisable. One way of dealing with that is to give those individuals EMI options that don't cost them any money at the point that they are granted the options, and they can get those options with a discount. So that £50,000 kind of entry requirement could effectively be reduced down to, say, £12,500 by using the EMI share option route. The valuation, that's when you're bringing in employees, that's the valuation is important. You can't be in a situation where, other than the discount on the EMI shares, you're giving value away, because then your management team can end up with income tax charges on the undervalue on those shares, and they're not going to thank you for that. So valuation is important, and we normally structure that by making sure that the consideration that the exiting shareholders receive strips as much value as necessary out of the holding company. Um, Gradual transition. So that's useful in the purchase of own shares. We had that strict kind of rule around really being broadly in one go is the reality. With this structure, you could theoretically go again and again. You could sort of reduce your interest to 30%, and then in a few years' time, there could be a further management buyout using another holding company. Um, Stamp duty on each occasion, stamp duty is paid on the full amount, which can get quite expensive when you've got big values. Big, 0.5% of a big number can still be a big number. Um, all these transactions, there's a statutory right to get an HMRC clearance. These are more complicated, so you just need to leave a little bit more time to kind of structure how it's going to work, including all the valuations. So you don't want to be putting in a clearance that's sort of half-baked. You want to sort of get your structure and your consideration. That means speaking to any banks that you're borrowing money from. But it is nice to know that the clearance is there, not only for people that are exiting, so make sure they get their capital gains tax treatment, but also for the shareholders that are rolling over, so they don't have any unexpected tax charges. Okay, that's a good summary, I hope, of a MBO.
And to keep things consistent with a visual aid, we have another little diagram for you all. You can see in this one, we've got these two happy people working in the company, loving their job, making the shareholders happy as well. And afterwards, we have, that holdco and tradeco structure again. But this time we've got our management team as shareholders as a result of an MBO. And you may notice the dotted line for the existing shareholders, because they may go out completely as part of this exercise, or they may retain that small ownership for a little period afterwards, managing the period of transition or just providing some support in a non-exec role. But that sort of summarises the management buyout side of things. And now we're going to look at something quite different, known as a capital reduction demerger. So this is very different, in terms of bringing people together. This is separating the business into two or more distinct entities. It's increasingly common and would be particularly beneficial ahead of a trade sale of a business. A capital reduction demerger is quite a complicated procedure, but there are many reasons as to why you might go down. The most common for which would be preparing your company for sale. You may have a company that you've had for 20 odd years. The trade's been brilliant. You've used some of that, your earnings to invest in other areas that are unrelated to the trade as such, and would be no benefit to any potential purchaser in the future, and actually would make the company harder to sell. So a demerger would give you the opportunity to separate all of that out. You may have a company, with two different sort of elements of risk. Something might be far more risky than something else, and actually having it all in one, entity or group structure is actually putting one area at risk of another. Something might be growing really quickly, and something might be more of a passive investment. They don't have matching aims with them. So it would just maximise your sale value, getting a nice clean trading company ready for sales. There are you'll see the sort of example we use in this this example, where we split a company with a trading business and an investment business into two, and with the same shareholders still maintaining interest proportionally. But there are also opportunities with a capital reduction demerger under the correct guidance and proper planning, where you could actually, if you've had a point where you've got to a point with a family and you're in disagreements with what to take, you have a way of splitting the company and taking your own sides forward in a nice tax efficient manner, rather than trying to sell a trade or asset to another company as part of that resolution. But many reasons why you might demerge is a much more complicated procedure than, not to say that the other options aren't complicated. All of this comes with an element of risk, but there is a lot more involved in this. But plenty of reasons, not just sale, as to why you might be looking at doing it. So I'm going to leave Matt to explain exactly what this is.
Yeah, so these are expensive. Conceptually, they aren't actually that complicated, but there is a lot of mechanics that go into a capital reduction demerger. but they're sort of necessary to avoid all sorts of taxes. If you start splitting companies apart um, without doing it in a tax appropriate way, you can have stamp duty, you can have capital gains tax, you can have income tax, and you can have corporation tax. You can have, four taxes hitting on the same transaction. This process allows that demerger to take place, typically without any of those taxes. The most difficult one to avoid sometimes is stamp duty or land transaction tax on properties. The essential idea is that it's got a fancy name, a capital reduction demerger, but the essential idea is you put a holding company on top, and when you put that holding company on top, that's tax neutral. And that holding company has the appropriate amount of share capital that can be reduced. So if you've got say, overall £10 million business and you've got a trading company that's worth 6 million and you've got properties that are worth 4 million, and you are in a situation where someone wants to buy your trading company for the 6 million but doesn't want your properties. And this is so common. It's so common for entrepreneurs to have had successful trading businesses and they've got to be successful. No one's going to buy them. And rather than taking the profits out as a dividend and paying all that tax, they take out the profits they need to live on. They can't bear the thought of leaving cash in the bank, earning very little. And so they invest those surplus profits in properties or other investments that are of no interest to the buyer. So along comes a buyer, they identify the 6 million, and they send you off to do a capital reduction demerger whereby you set this holding company up with this 10 million of share capital, and this new holding company sends out the £4 million of properties in a separate subsidiary, and the shares in the holding company are reduced, hence the capital reduction. They reduce from 10 million to 6 million. There's a lot of companies, there's a lot of paperwork, there's a lot of checking on stamp duty and VAT and um, trying to work out is it better as which way's better, who leaves who in this group. You've got to you create this group and you've got to decide who's leaving the group, and that can add some complexity. But get all these things right, the costs of doing it will always be less than the tax costs that can all be avoided if done properly. Um, so yeah, that's kind of the way I sort of think about it. My takeaway would be, have I got stuff in my company that no one's going to want to buy? What's the most efficient way of removing those things? And quite typically, the answer is expensive, but a clean and well-trodden process. Right, we've half an hour in, so we've got a little bit of time to do. Is it one more, is he, I think?
Yeah, it is. Just for consistency. So in terms of what Matt's just explained, here we have a company, and you can see at the bottom there's a mixture of property, cash, and the trade. And by doing that, incorporating a holdco, moving assets into another subsidiary, doing a capital reduction, transferring the shares to another company, all of this, step plan that Matt's just outlined is sort of what we're up with on the right, where we've got two separate groups now, unrelated. But you've got an investment group with all of that cash or property held, and then you've got the trading company on the other side, ready for any sale in the future. Advanced clearance is completely essential, as it is with every other thing we've discussed today. But it is just important to remember in this scenario that you would be doing it in advance for sale and preparing the company for sale. But once you have separated these entities out, they are unrelated. And there is, are considerations to have before you take that step in terms of having everything held separately rather than in one structure.
So if you put the 10 million example onto that slide on the right-hand side, so you've now got holdco. You can sell that for £6 million and pay your 18% and 24% capital gains tax, but only on the 6 million. And the 4 million, there is no tax on that. You just hold on to that. If you compared that with the sometimes alternative of selling everything and buying back the bits you don't need, that'd be very expensive. You'd have to pay the capital gains tax on the extra 4 million and then use some of your proceeds to buy back the bits that the buyer doesn't want. If, for example, there was a small residential flat that cost, I don't know, £200,000, it would be cheaper just to sell everything and buy back the flat. But what we often find is that people have collected a lot of assets that the purchaser doesn't want, hence needing to do this route. Okay, thanks, Izzy. So
And
what,
final thing then we're going to look at is sort of the removal of a subsidiary. It's sort of the aftermath of everything that we've discussed. Doing, these many options to restructure or bringing in holding companies, etc., does sort of end up with a number of entities within a group structure. And therefore, you might be a few years down the line and thinking, hang on a second, this is costing me money. I've got numerous entities now to, meet filing requirements for, get accounts done. Even dormant accounts will, cost you money as a business owner. You're sort of allowing yourself, there's an element of risk. Even if the company is dormant, missing that filing deadline, brings its own penalties and risk with that. It's also distraction, isn't it? You're busy running your business and all of a sudden now there's another entity to worry about. And you just maybe, 10 years on from a restructure are now thinking there is no purpose for this entity any longer. There can also be issues with cost guarantees for the banks. And all subsidiaries may carry the hidden risks. So getting rid of them in tax efficient manners and in, the correct way of doing things makes perfect sense, and sort of cleaning everything up following perhaps one of these restructure routes we've already discussed. Although it has to be done efficiently. And Matt will discuss the two options with you.
yeah, and this is so common, and I think often clients just live with it. Um, and if they've gone through multiple MBOs, it gets worse. And then I think what tends to happen is people get to a point where so many things have changed, no one can remember why something the way it is. And so you'll end up with situations where there'll be intercompany loans between entities that don't even have bank accounts. Um, and you come up to sell the business and it's just looks untidy, and the purchaser doesn't necessarily want all the grief. So sometimes it's just a case of biting the bullet and incurring the costs and dealing with it. So on the left-hand side, well, let's start on the right-hand side. So the right-hand side, if you've got entities that do have some latent risk, like a building company with potential claims on latent defects that you're no longer using in the group. I've seen situations where claims have come out the woodwork many years later in respect of asbestos and stuff like that. Then at some point, people think, crikey, I've got all this trading behind me. I'm going to hive that trade up into a new clean entity, but never necessarily deal with the old entity. And the way to completely kill that company off is to do what's called a members voluntary liquidation. That's a proper insolvency act process, and that costs money. That can cost £6,000, £7,000. But when you've got those sort of issues, you might want them to be completely put to bed. For situations that you're less concerned about, there's a much easier route. We can get the accounts tidied up and any balances can be waived, and we can get to a neat balance sheet. You can simply strike the company off. And that's, I think, a check you send to the company's house. I think I don't even know how much it is, £30. And providing nobody objects, the company struck off. If something does come out of the woodwork, it is possible for that company to be put back on the register. But those are the two ways of actually getting rid of some companies and not having all the admin that Izzy's spoken to. And then on the next slide, Izzy, we've got
Nice simple diagram this time. We're just showing, obviously before then we've got, a trail of companies sort of racking up, and afterwards a leaner, easier to manage group ready, for ongoing trade or, in preparation for sale.
Yeah, it's probably worth saying that some sometimes those companies you want to get rid of are in the middle. They're not at the bottom.
Yeah.
And there's more, then you can't get rid of that company because it might own the trading company. So then you need to distribute the trading company up to the holding company to make the middle company the bottom company. So um, I think the takeaway is if you've stepped into a role as a financial controller or a finance director of a new entity and you've no idea why the structure is the way it is, but it seems to be overly complicated. The answer is there's a reason it's there, and it probably is overcomplicated. It's probably unnecessarily overcomplicated, and there will be something that can be done. And the short-term benefits are not massive. It's the costs, but they're not huge costs compared to what it costs to get done. The longer-term benefits are if you're looking to exit that business, it's something you'll probably have to do later on anyway. So why not just bite the bullet and do it now? Okay. Did so I don't I'm looking at the Q&A. I think I'm looking in the right place. I don't actually think we have any questions. Hence why we ran on a little bit longer than the 30 minutes we said we'd stick to. So I've actually only left 3 minutes, but I don't think no. Intriguing. There's always one question. I'm assuming the Q&A is working. There's always the possibility that the reason Kerry put her hand up at the beginning was because it's not working. I think we'll leave it there. By all means, if there is questions specific to circumstances, then by all means, please contact your usual Bevan Buckland contact, or indeed Izzy, who will be very happy, I'm sure, to deal with the questions.
Of course.
Okay. Oh, no, it is working. Yes, it is working. Okay. Okay. Thank you, everybody. Thank
Thank
you for
you.